And luckily, judging from my voice, I can hand over to somebody else. France 24's Brian Quinn is joining us here in the studio for the business news, starting with some new clues to Elon Musk's plans for Twitter. You'll go, Brian.
So, Stuart, ever since Musk, in fact, began pursuing his $44 billion Twitter takeover, he's insisted that he's not in it to make money, though he is keen to improve the company's lackluster financial performance. Well, with Musk dropping public hints as to his potential plans for a shakeup at the company, doubts remain as to whether or not the deal will actually go through by year end as planned. And if it does, how long will Twitter stay in Musk's hands? Catherine Viette reports.
Elon Musk says he wants to make Twitter maximum fun. The billionaire has been sharing a few of his plans for transforming the social media app, which he's described as a niche platform, into something more appealing to everyone.
I'm looking for something that's, like I said, as broadly inclusive as possible, that's as trusted as possible as a system, and I hope we are successful in that regard.
As part of that transformation, Musk said in a tweet that businesses and governments using the service may be charged a slight fee, but that it will always be free for casual users. It's part of efforts to try and monetize the platform and increase revenue at the company. Musk has also vowed to take on spam bots, trolls, and scam artists using the site, promising greater transparency, including in how tweets are promoted or demoted. While Musk plans to take the company private in a $44 billion deal expected to close later this year, he has told potential investors that he could eventually return the platform to public ownership. The possible move is one commonly made by private equity firms that take companies private, fix issues, and then take them public again several years later. Still, not everyone's happy about Musk's takeover of Twitter. Concerns are growing over potential changes to the company's moderation policies, which Musk has called a threat to free speech, but that critics say are necessary to prevent harassment, hate speech, and misinformation from overrunning the platform.
Next, the latest two-day meeting of the Federal Reserve's Open Markets Committee wraps up Wednesday afternoon in Washington with a press conference from Federal Reserve Chair Jay Powell. America's central bank widely expected to raise benchmark lending rates by 0.5% as the country confronts its highest inflation rate in the past 4 decades. That level of rate hike is faster than the Fed's normal 0.25% increment, but with March consumer prices up by 8.5% over last year, the Fed is facing increasing pressure to take decisive action. Wednesday's rate hike is largely priced into the markets already, but analysts will be keeping a close eye on Powell's remarks for clues as to how aggressively the Fed will be continuing to raise rates this year.
Certainly the tone, the language of their comments that come out of the meeting are going to be very important in terms of whether or not those are more hawkish than what the street is expecting. That could cause some downside pressure as well.
A string of potential future U.S. rate hikes are weighing on the mind of investors on both sides of the Atlantic and the Pacific. Here in Europe, major indexes opened mostly flat as investors await that Fed presser. London just barely in the red. The CAC 40 here in Paris just barely in positive territory. Crude oil prices on the rise as Europe announces a 6-month phase-out of Russian crude oil imports. European benchmark Brent crude is up around 1.9% to trade at nearly $107 per barrel. U.S. stockpiles, meanwhile, on the decline as West Texas Intermediate tops 2% in gains to trade at $104.60 a barrel. Finally, for business, one of the key drivers of the current global inflationary trend is, of course, skyrocketing energy prices. Europe's new embargo on Russian oil likely to send those prices even higher. That's bad news for cash-strapped consumers, but great news for oil and gas companies, which have been raking in massive profits. That's leading to growing calls for them to face a windfall tax to offset the imbalance. Carolyn Lamblay explains.
Hamper investments or share the wealth more equally? It's a question that is still up for debate, as several governments in Europe push forward with windfall taxes amid soaring oil and gas prices.
If you put a windfall tax on the energy companies, what that means is that you discourage them from making the investments that we want to see that will in the end, keep energy prices lower for everybody.
Despite the Prime Minister's obstinance, Chancellor Rishi Sunak has suggested the government could explore the option. This comes in response to calls from Labour, as households and energy-intensive industries struggle to cope. A windfall tax is a one-off payment imposed by a government on a company or group of companies, which are seen as having cashed in on the rising prices brought on by external factors, in this case, the Ukraine war. Opponents of the tax are quick to point out that these companies employ thousands of people and often place some of their investments in pension funds, which means they are already sharing their profits. Elsewhere in Europe, there have been strikes and protests against rising fuel prices in recent months. Spain and Italy have already announced a windfall tax on energy companies. On Monday, the Italian economy minister announced that the windfall tax would be raised from 10 to 25% on profits made between October and March. The Italian windfall tax is expected to help bankroll a €14 billion stimulus package that was approved the same day by the Prime Minister, an attempt to shield Italian households and businesses.
Tough times for consumers, boom times for oil companies, Stuart.
Indeed. Thanks very much, Brian. Quinn with the business news. Time for